Alrighty, let's talk mortgage. Episode number 2. In this video, I will start with an example of a traditional fixed-rate mortgage. Let's assume we borrow $100. Interest rate is 5%. The loan will be paid off within 5 years. In reality, the mortgage is usually paid monthly, but for simplicity reason, for this example, I assume each mortgage payment will be paid once a year at the end of each year. The table shows from left to right beginning loan balance, interest expenses, principal payback portion, fixed mortgage payments, and ending loan balance for year 1 through year 5. So let's look at the purple column. The predetermined mortgage payment in this case is $23 per year for 5 years, and this is calculated based on 3 variables: loan amount, interest rate, and loan term. The blue column shows the calculation of interest expense per year, which is simply using fixed interest rate times each year's beginning loan balance. As you can see, because loan balance decreases by year, so does the annual interest expense. The yellow column shows the principal portion of the mortgage payment, which is calculated using fixed mortgage payment minus interest expenses. Notice, as the interest expense decreases by year, more of your mortgage payment goes to pay down the loan principal. The last column shows loan balance decreases year over year, which results in a lower interest expense each year. By the end of year 5, the loan is paid off completely. This slide shows an example of an interest-only mortgage. For easy comparison, we use the same assumptions on loan term, interest rate, and loan amount. The difference of an interest rate-only loan is that the loan principal will be paid as a lump sum amount at the end of loan term. The mortgage payments only include interest expense. So let's start with interest. Interest is still calculated using interest rate times loan balance. You can see in this case, the interest expense remains at $5 per year, not decreasing. Notice that the loan balance remains at $100 each year. This is because for interest-only loan, 100% of the mortgage payment is interest expense. No principal portion has been paid down over the entire loan period until the end of the loan term. So let's now compare the two examples side by side. Fixed rate mortgage on the left and interest-only mortgage on the right. The first difference is on the mortgage payment. A fixed-rate mortgage has equal mortgage payments. Each payment includes both interest and principal portion. In this case, $23 per year. On the other hand, for interest-only loan, the mortgage payment each year is smaller, $5 per year, because the mortgage payment does not include principal paydown. So 100% of the mortgage payment is interest expense. However, the borrower needs to come up with $105 at the end of year 5 to pay down the entire loan and year 5 interest. So this creates cash flow challenges. The second difference is annual loan balance. Loan balance for a fixed-rate mortgage reduces over time, while the loan balance of an interest-only mortgage remains the same each year until it is paid off in the end. Third difference is interest expenses. For a fixed-rate mortgage, the interest expense decreases as loan balance decreases. However, for interest-only loan, the interest expense remains the same. As the number shows, the accumulative interest expense for this fixed-rate mortgage is $15 over 5 years, while the total interest expense for the interest-only loan is $25. So, even with the same interest rate, the interest-only loan is more expensive. In reality, the interest rate on interest-only mortgage is usually higher than a fixed-rate mortgage because lender bears more risk on an interest-only loan. As always, be a smart consumer, do your homework, compare rates and origination costs. And I recommend you to check interest rate with me. You've got nothing to lose, but so much more to gain. So for questions on residential mortgage application, real estate purchases and sales in Washington State, please do not hesitate to contact me. Thank you so much for listening.